U.S. producer prices rising less than expected in March. The softer data comes on the heels of a hotter than expected inflation print on consumer prices. Jack Kleinhenz, the National Retail Federation chief economist, joining us now. Jack, it is good to see you. So maybe we'll start there, Jack. We did get another important inflation print today, March PPI. I'm interested, Jack, the trajectory of inflation. Where do you see it? Where we are, where we're headed, and what does it mean for consumers?
Well, thank you for having me today, Josh and Julie. Certainly, the inflation information that came out yesterday just created more uncertainty about where the Fed's going to go in terms of its changes in monetary policy. The certainty, though, is that it remains the number one problem for households and consumers. Actually, from a retail standpoint, we've seen a tremendous deceleration in retail prices over this past year. I look at the personal consumption expenditure index, and if you look at it on a year-over-year basis for the last 2 months, retail prices in general have been down almost 1%, again, on a year-over-year basis. So I think what we're seeing in many ways is the inflation pressure is still in the service industry, not so much in the goods industry.
And what effect is this eventually going to have on spending? I mean, the one report that caught our attention out yesterday from the Federal Reserve Bank of Philadelphia found that credit card delinquency rates in the U.S., the highest on record. What tends to happen, or is that sort of a forward indicator of spending?
Delinquencies are up. We've been watching it closely. They seem to be concentrated, though, at the low end of the income spectrum and for younger people. It is a concern to be watched. But overall, the balance sheets of the households are in pretty good shape. They have the income. They look pretty good in terms of the growth in income. The amount of debt they're servicing is still well within reason based on their wherewithal. So I think it's just sort of an issue that we're going to have to watch closely, and it's concentrated really in only really a small portion of the income spectrum.
You know, Jack, when we heard retailers reported earnings, one theme that emerged, at least some of those companies, when on their conference calls, you would hear the execs talking about maybe a shift here, consumers more focused on what they need rather than what they want. Is that what you're seeing in the data?
Yeah, I mean, there's no doubt about it. I think that there has been an evolution from where we were a couple years ago. And I think they're just being smart shoppers. Again, I believe that the household is in pretty good shape because they feel pretty secure about their jobs. They will continue to spend. But in terms of the things that they need, it's also the things that they need that have higher prices, and not so much in the retail world. As I've just mentioned, it's the service industries that are causing a real headache for households. Their cost of medical care, insurance on cars, all those service prices that we've seen in the CPI that have gone up. That's really a major headache for households. It's obvious to you, but it does wear thin over in the retail sector because there's going to be a trade-off on spending, let's just say, for discretionary retail goods versus non-discretionary.
And Jack, Ulta Beauty recently got some attention for sort of seeming to indicate that demand is slowing. Do you think, A, that could be a sort of canary in the coal mine, and B, is that a factor of what you're talking about, sort of households moving around budgets and reprioritizing?
Well, I can't comment specifically on that report, but I can just tell you that we are expecting a slower pace of consumer spending going into 2024 because we feel like the organic growth in jobs aren't going to be as strong in the economy, and if you have slower job growth, less income, there's less spending. And so we're really kind of looking at the dynamic of the broader economy as it relates to the retail industry. And of course, we've got to be careful too and recognize when we give you the numbers on retail spending, for instance, we're looking at growth between 2.5% and 3.5% for 2024. It's nominal dollars, not real dollars. So we have seen considerable price declines, like I mentioned. So there is growth, unit growth. It's just going to be clouded a little bit because of how inflation is impacting our retail prices.
Jack, thanks so much for your time today. Appreciate it.
Great to see you. Thank you.